A $100,000 salary used to sound like the finish line. In 2026, for many American families, it feels more like the entry fee just to live comfortably. After taxes, housing, transportation, groceries, insurance, childcare, and debt, a six-figure income can disappear before the month is over. So what changed? And how did the salary that once represented the American dream become a number that still leaves people feeling broke? Imagine Michael and Sarah. Together, they earn exactly $100,000 a year. Their friends assume they are doing great. Their family thinks money is no longer a problem. But every month, they look at their account and ask the same question. Where did it all go? The first answer is simple. They do not actually live on $100,000. That is the number on paper. Taxes, health insurance, retirement contributions, and other deductions take their share before the money reaches the bank. The salary sounds like more than $8,000 a month, but the spendable amount is much smaller. And that smaller number has to support an increasingly expensive version of ordinary life. Housing takes the first major bite. Whether they rent or own, they are not only paying for a roof, they are paying for insurance, utilities, maintenance, internet, repairs, and the price of living close enough to work, school, and basic services. Move farther away to save on housing, and transportation becomes more expensive. Move closer to work and rent rises. The cost does not disappear, it simply changes categories. Then comes the car. A reliable vehicle is not just one payment. It is fuel, insurance, registration, maintenance, tires, parking, and the possibility of a repair that wipes out a month of savings. But housing and transportation are only the beginning. The expense that really changes the emotional meaning of $100,000 is the one people feel every week. Food, insurance, and everything else that quietly became more expensive. Prices may rise more slowly than before, but that does not mean they return to the old level. The grocery bill does not rewind. Rent does not magically fall back. Insurance does not forget the previous increase. The old definition of a comfortable salary stays frozen in memory while the cost of comfort keeps moving. And this is where the real trap begins. When Michael and Sarah first reached six figures, they expected the stress to disappear. Instead, their expectations changed. The older car suddenly felt embarrassing. The apartment felt temporary. Eating out once a month became once a week. A better income gave them permission to upgrade several parts of life at the same time. None of those choices looked dangerous alone. Together, they created permanent monthly obligations. A newer car is not one expensive day. It can become years of payments. A larger home brings higher utilities, maintenance, insurance, and furniture costs. A premium lifestyle is not one celebration. It becomes a system that sends bills every month. The American dream quietly turns into a subscription. You do not buy it once. You keep paying to maintain the image of it. Then, Michael gets a raise. This should create breathing room, but before the money can build wealth, it is assigned to a better neighborhood. Another vacation. Upgraded phones. And more subscriptions. His salary rises, but his flexibility falls. More of next month's paycheck is promised before next month even begins. That is why a household can earn $100,000 and still feel financially fragile. They are not poor, but they have no margin. One medical bill, job interruption, major repair, or family emergency can push them onto a credit card. And a life that collapses after one missed paycheck is not the security people imagine when they hear the words American dream. But there is another force making this worse, and it has nothing to do with inflation. It is comparison. Michael and Sarah no longer compare themselves with the life they had 5 years ago. They compare themselves with co-workers buying larger homes, neighbors driving newer vehicles, and strangers online showing vacations, renovations, and perfect kitchens. They see the reward, but not the debt behind it. Social media displays the lifestyle and hides the obligation. So even when they are making progress, progress feels like failure. At $70,000, $100,000 looked rich. At $100,000, they notice people earning $200,000. The comparison group keeps moving upward, which means no salary automatically feels like enough. This reveals the biggest misunderstanding behind the modern American dream. Income is not wealth. Income is money moving through your life. Wealth is money that stays, grows, and gives you choices. A household earning $100,000 and saving nothing may be less secure than a household earning $75,000 that controls fixed costs, avoids unnecessary debt, and invests consistently. The important question is not, how much do you earn? It is, how much of your income still belongs to you at the end of the month? That gap is the real price of freedom. No gap means every emergency feels dangerous. A small gap creates breathing room. A growing gap creates options. And options, not appearances, are what make a person financially secure. So does the American dream really cost more than $100,000 in 2026? Not for every person, in every city, or in every household. But for many families, 6 figures no longer guarantees the life it once represented. Add housing, transportation, food, healthcare, childcare, debt payments, retirement savings, and an emergency fund, and the number can disappear much faster than people expect. The problem is not that $100,000 is a bad income. The problem is that people still treat it like a magic number. It is not. Without a system, every raise can disappear into a more expensive version of the same life. So, how do you stop that from happening? First, build your lifestyle around take-home pay, not gross income. The number on the job offer does not pay the bills. The amount that reaches your bank account does. Second, place a ceiling on fixed costs. Housing, car payments, insurance, debt minimums, and subscriptions should not automatically expand with every raise. Before accepting a new recurring payment, ask one question: would I still want this bill if my income dropped by 20%? If the answer is no, the upgrade may be buying status at the cost of security. Third, split every raise before your lifestyle experiences it. When income rises, direct at least half of the increase toward investing, retirement, debt reduction, or cash reserves. Money your lifestyle never learns to spend is money you are less likely to miss. And fourth, define your own version of the American dream. Maybe it is not the largest house, the newest car, or the most expensive vacation. Maybe it is a smaller home without panic, a reliable used car, more time with family, and the ability to handle an emergency without borrowing. Real freedom is often invisible. It looks like low debt, strong savings, controlled expenses, and the power to say no. $100,000 can still be a powerful income, but it is no longer a guarantee of wealth, security, or peace. Those things come from the gap between what you earn and what you permanently owe. The American dream has not disappeared. It has become more expensive, more complicated, and easier to fake. And the people who actually achieve it may not be the ones earning the most. They may be the ones who refuse to turn every raise into another bill. So tell me in the comments, what does the American dream cost where you live, and does $100,000 still feel like a rich salary? If this video changed how you think about income, hit like and subscribe, because the next video reveals why earning more can sometimes make you feel even poorer.